Welcome to Dorsey and Whitney's webinar on at-the-market programs for U.S. issuers. I'd like to introduce Anthony Marsico, a partner in Dorsey's Capital Markets and Corporate Compliance Group. Anthony?
Thank you. Good afternoon, everyone. My name is Anthony Marsico, and I'm a partner in Dorsey and Whitney's Capital Markets and Corporate Compliance Group, resident in Dorsey's New York City office. I'm joined today by my colleague, Nicole Strydom, who's also a member of our Capital Markets and Corporate Compliance Group, resident in our Minneapolis office. On behalf of the firm, I'd like to welcome you to Dorsey and Whitney's webinar discussing at-the-market offerings for domestic U.S. public companies. This is the first part of a two-part webinar series regarding ATM programs. The second part will be a webinar discussing at-the-market offerings for Canadian public companies, which will be held on Monday, October 19th at 2 p.m. Central Time, 3 o'clock p.m. Eastern Time. Attendees who would like to attend both programs should be sure to register for part 2 of this webinar series in the invitation email you received from events@dorsey.com. Our program today will run about 60 minutes, during which we'll be discussing a range of topics relating to ATM programs for U.S. public companies, including an overview of ATM programs, current industry data regarding ATMs, a comparison of ATM programs versus other methods of public and private securities offerings, the logistics of preparing, launching, and maintaining an ATM program, and certain stock exchange and regulatory issues that typically arise in connection with ATM programs. Before we get started, the materials that we will be walking through during this program, as well as an attendance form, are available for download from Dorsey's reminder email that you should have received from events@dorsey.com. We ask you to please return your completed attendance form to attendance@dorsey.com, and CLE certificates will be sent to those who return completed forms. Unfortunately, because we have a great deal of material to go over in just 60 minutes, we're not going to have time for a Q&A at the end of the program. However, attendees with questions on the material covered today can contact the speakers directly following the program, or you can reach out to your trusted Dorsey contact. Speaker contact information is included in the materials for today's webinar. So with that, I'd like to turn it over to my colleague, Nicole Strydom, who will begin with an overview of ATM programs. Nicole?
Hello, everyone. Most of you are likely familiar with at-the-market programs, but for those of you who aren't, we'll go through a quick overview. An at-the-market program allows for a public offering of equity, not debt, securities by a U.S.-listed company into an existing trading market for the stock through one or more registered broker-dealers at other than fixed prices approximating prevailing market prices. Companies that are eligible to have an ATM program are U.S. or foreign public companies with equity securities listed on a U.S. market that are eligible to register a primary offering on Form S3 or F3, Canadian public companies using Form F10, and as Tony mentioned, if you're interested in hearing more about that process, tune in next week on October 19th, and closed-end investment companies eligible to register a primary offering of securities on Form N2. As noted at the top of this presentation, we're going to focus on U.S. domestic companies. So a domestic company eligible to have an ATM program will have either an effective Form S3 shelf registration statement or a plan to file a new Form S3 for the ATM program. Plus, it will also have a public float of at least 75 million as of a date within 60 days from the most recent determination date, which we've defined below. If the float is more than 75 million at launch, the ATM can be any size, or no specified dollar amount needs to be referenced in the ATM agreement. This next slide sets forth the eligibility requirements for a company to use the Form S3. For the Form S3, the company must be a domestic U.S. company and have a class of securities registered under the Exchange Act. It must have been subject to the reporting requirements of the Exchange Act for at least the past 12 calendar months and have timely filed all required reports with the SEC during those 12 months. Zooming back out to general ATM eligibility, if the public float is less than 75 million at launch, or if it later falls below 75 million at a determination date after the ATM launch, determine if baby shelf rules can be used going forward. Assuming that the company is Form S-3 eligible and that its equity is listed on a national exchange, the thing to focus on here is that the company must not have sold securities valued at more than a third of its public float in certain primary offerings over the previous 12 calendar months. If the company determines that it can use the baby shelf rules, then it may sell stock up to a third of its public float in any rolling 12-month period. Although we've outlined below some qualifications to that statement. Let's move on to industry data that we've collected on ATMs. Tony?
Thanks, Nicole. So what you'll see in this slide is that basically since 2005, ATMs have been widely accepted by the capital markets and companies across most industries. So 2005 was really the year that ATMs really took off, due in large part to the securities offering reforms that went into effect in December 2005. Since that time, companies no longer had to file post-effective amendments, which were subject to SEC review, in order to effect a takedown off an effective shelf registration statement. So since December 2005, takedowns off an effective shelf can be done by filing a prospective supplement with the SEC without any SEC review, obviously a much simpler and faster process than before. In 2019, ATM issuances represented 33% of U.S. equity offerings. So basically a third of all equity offerings in the US are ATM transactions. Generally speaking, ATMs have consistently grown in popularity each year since 2005 at a pretty big clip each year. Especially when the baby shelf rules took effect in January 2008, microcap companies that needed quick access to the capital markets began using ATM programs in earnest. And each year since became a larger and larger segment of the market for ATM programs. While biotech and pharmaceutical companies and REITs use ATM programs the most, ATMs have become increasingly popular in other industries such as oil and gas, metals, minerals, and stones, mining, consumer retail, electronics, clean tech, and investment companies. Companies at all levels of market cap are taking advantages of ATMs. If you look at this pie chart below, you can see that companies with market caps of less than 250 million represent about 37% of the ATM market. Companies with market caps of between 250 million and $1 billion represent about 27% of the ATM market. And companies with market caps of between 1 billion and 2.5 billion and companies with market caps greater than 2.5 billion represent about 13% and 23% of the ATM market, respectively. ATMs are also widely used by foreign private issuers in countries all over the world, including the UK, Canada, Australia, France, Germany, the Netherlands, Switzerland, China, India, and Israel. Foreign companies with dual listings in the UK on the LSE, the London Stock Exchange, in Canada on the Toronto Stock Exchange, the TSX, which is the Toronto Venture Exchange, or the Canadian Stock Exchange, and in Australia on the Australian Stock Exchange, and in Israel on the Tel Aviv Stock Exchange, are perhaps those that use ATMs the most, because the rules of those exchanges are flexible with ATM offerings that are conducted on the facilities of a US exchange or on an electronic communications network of a US exchange. Next slide. So on this slide, as you can see, more ATMs have been announced in the first 3 quarters of 2020 than in any previous year. As of September 30, 2020, there have been a total of 406 ATM transactions announced, with over $51 billion of total commitment. The number of deals during the first quarter of 2020 outstripped the number of deals for every previous quarter during the past decade. And the number of deals filed in the third quarter of 2020 was almost double that of the first quarter this year. The median issuer market cap appears to be around 250 million, with half of the companies using ATM programs below that market cap and half above that market cap level. In 2020, the market cap of companies using ATMs range as low as 2 million to as high as 464 billion. Next slide. In this slide, you can see the breakdown of companies that use ATMs the most by industry sector. Again, biotech and pharmaceutical companies and REITs are by far the industry sectors where ATMs are used the most. In the first 3 quarters of 2020, there were 126 ATMs announced for biotech companies looking to raise almost $9 billion. 80 ATMs announced for pharmaceutical companies raising about $5.3 billion. 44 ATMs announced for REITs, which typically tend to be the largest ATMs, with about $16.3 billion total commitment. Below those, you can see the next few industry sectors where ATMs are currently widely used, including oil and gas, metals, minerals and stones, and mining companies, followed by companies in the electronics, investment companies, retail, restaurants, and transportation industry sectors. Now, to the right, we have a couple of pie charts that show the industry breakdown for the last trailing 12 months versus the industry breakdown over the 10-year period from 2010 to year-to-date 2020. Here you can see how companies in the healthcare industry have become an increasingly larger portion of the entire market for ATMs. Historically, about 40% versus 51% currently. And REITs, while still raising the most money through ATMs, are becoming a smaller segment of the overall ATM marketplace, shrinking from about 18% to 14%. And with that, I'd like to turn it back over to Nicole, who's going to walk us through a comparison of ATMs versus other types of public and private equity offerings, illustrating the many pricing and other advantages of ATMs compared to other types of financings. Nicole?
So let's look at why you might want to implement an ATM program. ATMs have a number of advantages over other capital raising options like pipes, fully marketed, follow-ons, CMPOs, registered direct offerings, and equity lines. For one thing, ATMs are pretty much without exception cheaper than other financing options. The range of commissions is usually 2 to 3.5%, typically an inverse proportion to the size of the ATM facility. And in 2020, it has ranged from as low as 0.5% to as high as 6%. There are also no discounts, warrants, or excessive fees. We put a chart in here comparing the average discount, average placement fees, and effective discount of bought deals, traditional follow-ons, and ATMs. And you can see that the savings can be pretty significant. In addition to the commissions, there's also usually a small bank legal fee reimbursement obligation on the part of the company that's payable upon the ATM's launch. There are also ongoing maintenance fees to keep the ATM program in place, although these are still less relative to other offerings. The other nice thing here is that quarterly bring down due diligence, legal opinions, and comfort letter obligations are usually suspended during quarters when the ATM is not in use. There's also less impact on the stock price. The share price impact after filing an ATM is negligible, with average prices increasing after 5 days. Even when stock prices are minimally impacted, they typically rebound very quickly. And in many cases, stock prices have risen upon announcement of an ATM because the market knows the company now has ready access to capital quickly, even during periods of market turmoil. ATMs are also fast and flexible. Sales orders can be changed as frequently as daily and even during the trading day. The company has the flexibility to control the timing and amount of sales and minimum acceptable price, so it can take advantage of windows of opportunity. The money also gets to the company pretty quickly, with receipt of proceeds typically occurring on a rolling T+2 settlement cycle. An ATM offering also has less market volatility risk. Since it can be done so quickly, I think we skipped a slide, excuse me. Since it can be done so quickly, a company can take advantage of volatility in the company's favor and sell shares at a premium to the company's average trading price over time, rather than doing so at a discount in a traditional deal. An ATM also allows a company to take advantage of high volume trading days in real time. A company can match sources in particular uses and raise money on an as and when needed basis. And orders can be conveniently set on autopilot with instructions to sell at or above certain prices at certain percentages of average daily trading volumes. It's also a transparent process. The company is kept informed on a daily basis as to trades made under the ATM, prices, and the gross and net proceeds to the company. If you need more convincing, there's also wide market and industry acceptance. It's become standard fare, good corporate housekeeping for companies to have an ATM program to draw on. ATM programs are a fantastic tool, but they're not a blank check. You're limited by the company's market liquidity. ATMs are also not available to companies that aren't eligible to use Form S3 or who lose that eligibility. So companies that can only use a Form S1 registration statement have to look for other alternatives that might be less attractive. The thing to keep in mind here is that ATMs are one arrow in the company's quiver, and they're not meant to replace entirely other forms of public and private offerings. If market conditions are advantageous and the company's status enables it to take advantage of larger one-off transactions at attractive prices. However, ATMs are a cheaper alternative to most other types of offerings at most times, so they are good for the company to have on the shelf and ready to use. ATMs also can provide assurances to a company that it will have a means to access equity capital in turbulent markets. In fact, it's one of the only capital raising tools that can be counted on by companies in volatile markets and functions as a sort of insurance policy for companies in times like these, where there are wide swings in capital market saturation in certain industries, and where access to capital for companies in certain industries just shuts down, sometimes when companies need access to capital the most. Now, let's move on to the nuts and bolts of an ATM program. You can see here a bird's eye overview of the process in its entirety, beginning with the preliminaries of a term sheet and an organizational call to discuss the process and the expected timetable, and then moving on to the due diligence, the preparation of documents, getting the required approvals, and then on to implementation and launch, and subsequently to the required ongoing maintenance. I'm skipping over the preliminaries here and going straight to diligence. The same level of due diligence is conducted for an ATM as any firm commitment public offering. However, it can be done in a very streamlined fashion because companies are already public and Form S-3 eligible companies have most material information already in the public domain. It is important to keep in mind here that both the company and the agents are subject to liability for material misstatements and omissions in the shelf and any ATM prospectus supplement, regardless of whether made intentionally or negligently. Also, the fact that these ATMs often go forward at lightning speed does not grant any kind of defense against liability. We're going to briefly take you through the two methods of implementing an ATM program. This slide shows a shelf takedown of an already effective registration statement. Looking at this chart, if there is already an effective shelf registration statement, and you're not bumping up against that 3-year shelf expiration date anytime soon, and there are sufficient shares left to cover what the company wants to include in the ATM, then it might be a good option to use that existing shelf and plan to file an ATM prospectus supplement at launch. Keep in mind, however, that the SEC has limited initial prospectus supplements at launch to true at-the-market offerings only. And this is because the only terms that are known at the time of filing the initial ATM prospectus supplement relate to at-the-market offerings. So while the ATM sales agreement may permit transactions such as privately negotiated transactions, block sales, and principal purchases, because the terms of those types of transactions are usually not known at the time of filing the initial ATM prospectus supplement, the initial ATM prospectus supplement cannot refer to those other types of transactions. At the time pricing and other terms of such transactions do become known, a supplement to the initial ATM prospectus supplement would need to be filed with the SEC disclosing those terms. Something else to note is the 180-day grace period. So if a new registration statement is filed prior to the date on which the existing shelf will expire, the company may continue to conduct offerings off of the expiring shelf registration until the earlier to occur of 180 days from that expiration date or the date that the new registration statement is declared effective. Over to you, Tony.
Thanks, Nicole. All right, so now I'm going to discuss the process of including an ATM program in a newly filed Form S-3 registration statement versus the process Nicole just talked about, which was launching an ATM program off an already effective Form S-3 shelf registration statement. So when an ATM is launched as part of a newly filed Form S-3 shelf, the Form S-3 shelf includes two prospectuses: preliminary base prospectus, which is always included in a Form S-3 shelf, and a preliminary ATM prospectus that specifically relates to the ATM offering. The process of preparing the ATM program as part of a newly filed Form S-3 is virtually identical to the process of preparing and launching an ATM program off an already effective Form S-3 that Nicole just explained. The main difference is that the due diligence process, the document preparation process, and the execution of the ATM program all occur prior to filing the Form S-3 shelf with the SEC, as opposed to after the ATM shelf is declared effective by the SEC. Including an ATM program as part of a newly filed Form S3 shelf has a few key advantages over the process of launching an ATM off an already effective S3 shelf. First, including the ATM as part of the S3 can be a good way to go because the marketplace has pretty much universally accepted this as routine housekeeping, and the ATM program will be effective for the entire life of the shelf S3. Second, there's a growing trend that's become more and more widely accepted, and that is companies that include ATM programs as part of the Form S3 are not separately announcing the implementation of an ATM program in a Form 8K filed simultaneously with the filing of the Form S3, because basically the ATM program is already fully described right in the Form S3, and the ATM sales agreement is simply attached as an exhibit to the registration statement, which obviates the need to file a separate Form 8K. Moreover, once the S3 is declared effective by the SEC, the ATM program can immediately thereafter be used by the company without having to file the ATM prospectus that was included in the Form S3 at the time of effectiveness as a separate filing with the SEC under Rule 424B of the Securities Act, as long as there's no material information that needed to be disclosed in the ATM prospectus following the date that the registration statement went effective. What this does is further reduce any minor market overhang concerns even further because there's no signal to the marketplace that the company is launching an ATM program through any separate standalone filing with the SEC. It's a good way to launch an ATM program without signaling to the marketplace that any public offering is necessarily imminent. Next slide. So this slide delineates the documentation process, which again is virtually identical no matter whether the ATM program is included as part of a newly filed Form S3 or is done as a takedown off an already effective Form S3. The main difference is the timing at which the process is implemented relative to the filing and effectiveness of the S3 shelf. So what's involved basically is the agent's counsel typically prepares an initial draft of the ATM agreement related transaction documents. Company counsel prepares forms of legal opinions, 10b5 negative assurances, any notices or filings with the Securities Exchange, press releases, if there will be a press release, and certain ancillary documentation. And if the company is doing this as a shelf takedown from an already effective S3, the company would be preparing a current report on Form 8K and the initial ATM prospectus supplement. If the company is filing a new Form S3 and the ATM is being baked right into the S3, then the company, in tandem with all this, is preparing the registration statement with the ATM prospectus included. Related transaction documents include a SAS 72 audit comfort letter. Agents counsel and company counsel negotiate and finalize the documents, and the company files the required notification or additional listing application to have the shares listed on the applicable U.S. Securities Exchange. The deliverables required in order to, quote, turn on the ATM program, such as the signed legal opinions, 10b5, negative assurances, comfort letter, officer certificates, etc., are either delivered upon signing the ATM sales agreement or in many ATM programs, not until immediately prior to the time the ATM program is first to be used by the company. Next slide. So this slide sets out the fees typically payable by the company upon the launch of an ATM program and when an ATM program sales are made. As you can see, the sales agent's commissions typically range between 2 to 3.5% of the gross proceeds of at-the-market sales made under an ATM program, with the median of 3% in deals announced in 2020. The sales agent's commissions are usually in inverse proportion to the size of the ATM program, with very large ATMs, typically in the billion-dollar ranges, having lower commissions and smaller ATMs having higher commission rates. Commission rate for deals announced in 2020 ranged from a low of 0.5% to as high as 6%, which is sort of on the very high side. Again, the range is usually between 2 and 3.5%. That's typical for most ATMs. Auditors' fees could vary widely and really depend on the accounting firm the company uses and the level of comfort the sales agent requires, and things like whether there are any pro forma financial statements that need to be comforted, if there are non-GAAP financial measures that the company uses, if there are any off-balance sheet transactions, etc. Also, if the company has recently switched auditors, comfort letters from more than one accounting firm might be necessary. The company oftentimes also has an obligation to reimburse the sales agent for a portion of its legal fees, up to a certain maximum amount, and those range anywhere between, say, $50,000 and $125,000, largely depending on the type of company if the company's got a lot of intellectual property to review and due diligence, if the company's in a heavily regulated industry, if it's a foreign private issuer, if there are any complicated tax matters or litigations, or if opinions from multiple law firms are going to be necessary, et cetera. The SEC registration fee for non-WIC-C companies that need to file a new registration statement to launch the ATM program is another expense. A WIC-C is basically a well-known seasoned issuer, and they can use pay-as-you-go rules to pay the SEC filing fees when they do a takedown off a registration statement rather than pay the filing fee at the time of filing the Form S-3. Company also has to pay its legal counsel fees, its own legal counsel, financial printer fees, and FINRA filing fees if applicable. Next slide. So here we have a diagram that outlines the whole process of launching an ATM when the company is launching an ATM off an already effective S-3. As we already discussed, the whole process of due diligence, document preparation, negotiation, board approval, signing the ATM agreement, filing the Form 8K, which does need to get filed when you launch an ATM off an effective S-3, as opposed to when the company makes the ATM in a newly filed Form S-3. And the filing of the ATM prospectus supplement with the SEC all occur after the effective date of the Form S-3 shelf. Next. Here we have a diagram outlining the process of including an ATM as part of a newly filed Form S-3. Again, the whole process of diligence review, document prep, negotiation, board approval all occur in tandem with the preparation of the Form S-3 registration statement. The ATM sales agreement is typically signed at the time the Form S-3 gets filed with the SEC and gets attached as an exhibit to the Form S-3. As we mentioned before, unlike the shelf takedown process, it has become much more common for there to be no separate filing of Form 8K announced in the program or any filing of a final ATM prospectus supplement following the effective date of Form S-3, unless material disclosure needs to be included. So at this point, I'm going to turn it back over to Nicole, who will walk us through the mechanics of using an ATM after it's launched. Nicole?
So after launch, the company can sell the shares whenever it needs funds or sees good market opportunities. And it does this by delivering a written placement notice to the agent with very specific instructions. The agent will not be executing any sales unless and until it receives a written placement notice that's in accordance with the terms set forth in the ATM agreement. Once it receives that placement notice, the agent will make sure that all the prerequisites are satisfied, including that there are not any current blackout periods, that bring down diligence has occurred, and that all bring down documentation, including opinions, closing certificates, and comfort letters, have been received. As we've noted before, this is a flexible tool, and the company and the agent are generally able to suspend sales at any time, even intraday. This can be particularly useful for a company if it has material non-public information and wants to make a material public announcement about a transaction or regulatory matters, litigation, etc. It can also be useful if the agent is providing research coverage and the company needs to suspend its ATM sales within a certain time period prior to a research report being issued. Another thing to keep in mind when using the ATM program is that if the company announces earnings in advance of filing its 10Q or 10K, if those earnings are furnished and not filed, that information will not be incorporated by reference into the Form S-3, which means that the ATM prospectus is not necessarily current until the 10Q or the 10K is filed with the SEC and incorporated into the ATM. As I mentioned, an important restriction on using the ATM program involves blackout periods. A company will need to be aware of two separate tracks for blackout dates, one for insiders and one for the company. For most companies, a blackout period for purposes of using the ATM is not coterminous with the company's insider trading blackout period, which is usually much longer. As a general rule of thumb, most companies consider themselves to be blacked out within 2 weeks of issuing their quarterly earnings. So the analysis is once the quarterly numbers become firm and if they're material, the company should not be in the market using the ATM until the quarterly results are publicly disclosed. In addition to blackout dates, no sales under the ATM program may be made if the company or the insiders are in possession of material non-public information, or if a previously filed prospectus now contains a material misstatement or omission and hasn't yet been corrected. The key here is that unlike the blackout period dates, possession of material non-public information is a facts and circumstances analysis. To keep the ATM active after launch, there's ongoing maintenance on both the part of the company and the agent. On the company side, the company will need to disclose aggregate sales and commission amounts paid on a quarterly basis in a prospectus supplement or in the company's Form 10Q or Form 10K. Companies should also consider when the aggregate level of activity under an ATM program may warrant public disclosure sooner than the next occurring report. On the agent side, the agent must conduct ongoing due diligence during the entire term of the ATM on both a quarterly basis at or near the time quarterly financial information is publicly announced. Although, as we've mentioned, many ATM programs will suspend quarterly bring down obligations when the ATM is not being used. The agent must also conduct diligence on an annual basis at or near the time fiscal year-end financial information is publicly announced, and at other times if material events occur, such as a restatement of financials, a material M&A transaction, etc. Company-specific factors may also influence requirements for quarterly versus annual bring-downs. For example, some banks require audit comfort bring-downs only on an annual basis versus every quarter. And annual-only comfort bring-downs are obviously much cheaper for the company than needing one every quarter. And now I'm going to turn it over to Tony to talk about the differences between the exchange requirements.
Thanks, Nicole. So now I'm going to spend a little bit of time discussing some of the differences in how the various stock exchanges look at ATM programs. So basically, each of the New York Stock Exchange, the NYSE American, and the NASDAQ exchanges requires stockholder approval for certain offerings of common stock at a discount to the current market price. The offering can result in the issuance of more than 20% of the common stock outstanding immediately prior to the execution of the definitive transaction agreement. NASDAQ, in particular, requires shareholder approval for transactions other than public offerings involving the sale, issuance, or potential issuance by a listed company, common stock equal to 20% or more of the shares of common stock, or 20% or more of the voting power outstanding before the issuance at a price less than the, quote, minimum price, the way NASDAQ has it defined, which is basically the lower of the official closing price of the common stock immediately prior to signing, or the average official closing price of the common stock for the 5 consecutive trading days immediately prior to signing. If the stock is issued at or above the minimum price, it's considered an at-market deal, and the 20% rule limitation will not apply. The NYSE 20% rule is very similar to NASDAQ's 20% rule. Similar to NASDAQ, the NYSE accepts from the application of the 20% rule any, quote, public offering for cash and any issuance involving a, quote, bona fide private financing, if such private financing involves the sale of common stock for cash at a price at least as great as the, quote, minimum price. And NYSE recently amended the rules to use pretty much the same definition that NASDAQ uses for minimum price. All 3 exchanges require an issuer to obtain shareholder approval prior to an issuance of securities that will result in a change of control, the way the exchanges view them. So now basically talking about public offerings and what constitutes a public offering, not all offerings that are registered with the SEC are considered, quote, public offerings for purposes of the 20% rule, the way the exchanges view them. Under each exchange rules, an offering is not deemed to be a public offering just because it's made pursuant to a registration statement. That said, a firm commitment underwritten offering that is registered with the SEC usually will be considered a public offering. Each of the exchanges will consider all relevant factors when determining whether an offering qualifies for the public offering exemption, including the type of the offering, whether it's conducted by an underwriter or on a firm commitment basis, whether it's conducted by an underwriter or placement agent on a best efforts basis, or whether the offering is self-directed by the issuer, the manner in which the offering is marketed, the extent of the offering's distribution, including the number of investors who participate, the offering price, and the extent to which the company, as opposed to an underwriter, controls the offering and its distribution. For example, let's look at 2 different transactions. Although a registered direct offering by definition is a public offering for SEC purposes, a registered direct offering to institutional investors that are not actively marketed to, quote, retail investors will not be considered to be a public offering by NASDAQ because NASDAQ's unwritten policy is to consider whether the offering was marketed widely to retail investors. Also, NASDAQ expects the company to issue a press release announcing the offering in advance of completion of the marketing effort. Now contrast the CMPO, which is a confidentially marketed public offering. So CMPOs will typically not be subject to the 20% rule by any of the exchanges. The reason is CMPOs are firm commitment underwritten offerings. Also in a CMPO, the company will issue a press release at the close of market on the last day of confidential pre-marketing, at which point the offering becomes public and retail investors can participate, which further satisfies the public offering requirement of the exchanges. Next slide. So now let's look at how ATMs are viewed by the exchanges. As a general matter, each of the exchanges view ATMs as a public offering because by their nature, ATM offerings are by and large sold through one or more sales agents on an agented basis widely into the public markets, with the sales agent deemed to be a statutory underwriter engaged in a distribution. The exchanges, however, typically require the company to provide certain certifications at the outset of an ATM program in determining whether the ATM program will be considered a true public offering for purposes of determining whether the 20% rule will be applied. For instance, NASDAQ will require the company to certify that the bulk of the securities sold through the ATM program will be sold through one or more sales agents on a, quote, agented basis in sales that are true at the market offerings under Rule 415 of the Securities Act, as opposed to, say, privately negotiated transactions or block sales or principal purchases that are not deemed to be at the market offerings. If the company can make that certification at the outset, the entire ATM program will not be subject to the 20% rule by NASDAQ, even if certain sales are affected in privately negotiated transactions or other non-at-the-market offering trades. As long as the substantial majority of sales are at-the-market sales on an agented basis, the whole ATM program will be considered a public offering and not subject to NASDAQ's 20% rule. The NYSE and the NYSE American exchanges also require the company to make a certification at the outset of the ATM program, but unlike NASDAQ, they may apply the 20% rule to certain non-at-the-market sales that are made under the ATM program. The NYSE and the NYSE American exchanges require the company to certify that unless sales through an ATM program are at-the-market offering sales or prior stockholder approval has been obtained, the company will not sell securities through the ATM program in an amount greater than 20% of its outstanding shares or in a transaction that would result in a change of control. So basically, the NYSE and NYSE American will exempt from the 20% rule all at-the-market offering sales through an agent under an ATM program, but may apply the 20% rule limitation to sales made in certain privately negotiated transactions, block sales, and other types of sales that are not true at-the-market sales. So basically, the company has to effectively ensure, depending on which exchange you're on, that the majority of sales affected through an ATM program are made on an agented basis in sales that are deemed to be at-the-market offerings under Rule 415 of the Securities Act, in order to ensure that in the case of NASDAQ, the 20% rule limitation will apply to all, the entire ATM program, and in the case of the NYSE and NYSE American, sales made in other than at-the-market offerings under the ATM program will not exceed the 20% rule limitation. So we'll come back to other issues in connection with block trades and privately negotiated transactions a little bit later in the program. But for now, I want to discuss OTC market listed companies. So can we get on the next slide? Okay. So in this slide, I'm going to speak briefly about ATM programs for OTC market companies. First, let me say at the outset that OTC market companies cannot use the baby shelf rules under Form S-3, because baby shelf rules require the company's stock to be listed on a national securities exchange, and OTC markets are not considered a national securities exchange by the SEC. So in order for a company with securities listed on OTC markets to use Form S-3 on a primary basis, the company must have a public float in excess of 75 million. So now, while some OTC market companies do qualify to use Form S-3 on a primary basis, virtually no ATM programs are implemented for OTC market companies for a couple of reasons. One main reason is that because state blue sky securities laws are not preempted for securities listed on OTC markets the way they are for securities listed on a national securities exchange. excuse me, because ATM sales are usually made on an anonymous basis to purchasers that may be located anywhere in the US. In order to conduct at-the-market offerings through an ATM program, the company would have to basically register or qualify for an exemption in all 50 states to avoid running afoul of state blue sky laws. And that's usually not a practical way to go for most companies, nor is it really compatible for an ATM considering the anonymity of at-the-market sales. Moreover, over the past few years, it's become extremely difficult and costly to clear OTC stocks through most clearing firms in the United States, many of which will simply not clear OTC stocks anymore as a general rule, which makes settling the ATM sales on a rolling T+2 settlement cycle extremely difficult for OTC market companies. There's maybe one instance that I can think of where it might make sense for an OTC market company to implement an ATM program, and that's basically where the OTC market company is contemplating an uplisting to a national securities exchange in the near term. In that case, if the company qualifies to use Form S-3 while it's on OTC markets because it has a public float in excess of 75 million, the company can put an ATM in place and the sales agent can use the ATM program to cross blocks to institutions located in a state or other jurisdiction where the company either is registered or qualifies for an exemption under the blue sky laws of that state, until the company uplists to a national securities exchange, after which time the company can then utilize the ATM program just like any other exchange-listed company. So now I'm going to turn it back over to Nicole, who will take us through the FINRA filing requirements for ATMs.
For purposes of ATMs, FINRA Rule 5110 requires an ATM sales agent to file certain information regarding its compensation unless a filing exemption for the company exists. So, who qualifies for a filing exemption? Experienced issuers, which is a new defined term under FINRA's recent amendments. And an experienced issuer is an entity that has a reporting history of at least 36 calendar months, at least 150 million aggregate market value, or the aggregate market value is 100 million or more, and the issuer has had an annual trading volume of at least 3 million shares. Perhaps the most important FINRA development in terms of ATM programs is that as of September 16th, if a company has a base shelf registration statement that's already been filed and cleared by FINRA, or if it qualifies for an exemption from that filing, then any takedown from that shelf, including the launch of an ATM program, no longer requires an additional FINRA filing. So this means that FINRA's review and requests for additional information will now take place post-prospectus supplement filing. According to FINRA, how this works is that they've built a proprietary back-end system that scans takedowns from the SEC's Edgar system after they've been filed. This system is a risk-based and likely uses AI to search for underwriting compensation terms. So any objections letters from FINRA will now be issued at the time the base shelf is filed, and no objections letters will be filed at the time of a takedown. Tony, back over to you.
I'm going to try to get through the research issues as quickly as I can because there's quite a bit to cover here. Now, with respect to research coverage, if a sales agent that has an ATM program in place for a company and the agent either wants to continue to provide research coverage or initiate research coverage for that company, during the ATM, there's a number of issues that need to be considered to determine whether the sales agent can use research reports during the term of the ATM program. Now, if you look at this chart, the column all the way to the left, the status of the company determined by the amount of its public float, which is calculated at the later of the effective date of the Form S-3, any post-effective amendment, and the filing date of its most recent Form 10-K, and whether or not the company is an emerging growth company, impacts greatly how and when research reports can be issued by the sales agent during the term of the ATM program. In the case of companies with a public float, let's look at the first row underneath the headings. In the case of companies with a public float of less than 75 million, you'll see that in the column to the right of that, the second column from the left, the securities of those companies will not qualify as actively traded for purposes of Regulation M. And that's because actively traded status requires an average daily trading volume of greater than $1 million and a public float greater than $150 million at the time the research report is issued. So basically, if it doesn't qualify as actively traded, that means a Reg M restricted period applies to the ATM. And we'll get into Reg M restricted periods in a bit. So in the next column to the right, the third one from the left, you'll see that for these companies, they also do not qualify for the use of Rule 139 under the Securities Act, because one of the requirements of Rule 139 is that companies have a public float of less than $75 million. Now, this is really important because the publication or dissemination of research reports under Rule 139 is an accepted activity under Regulation M, which technically enables a sales agent to issue research reports during a Regulation M restricted period. If Rule 139 is not available, then the Reg M restricted period must be stopped before the research report can be issued. As you see in the fourth column from the left, in this case, in order for a sales agent to issue a research report for one of these companies, the company must provide a written notification of the sales agent of a suspension of the ATM sales under the ATM sales agreement, assuming that the sales agreement provides for suspensions, most of them do. And all ATM program sales must be suspended immediately upon receipt of the suspension notice. At that time, the sales agent should file a restricted period termination notice with FINRA prior to the opening of trading on the first day of a 3 calendar day waiting period, which you see in the fifth column there, which basically cuts off the distribution restricted period under Reg M. 3-day waiting period prior to issuing research is a FINRA rule requirement, which prohibits a FINRA member from publishing or distributing research reports on a company that's not an emerging growth company for a minimum of 3 full calendar days following the date of a secondary offering of securities, which is what an ATM is. Then after the research report is issued, there's another waiting period that must expire before the ATM sales can begin again. You see in the last column on the right, usually it's 3 calendar days or maybe longer depending on the bank. Or if an applicable Reg M restricted period is 5 trading days as opposed to 1 trading day, which is basically for issuers with average daily trading volume of less than $100,000 or a public float of less than 25 million, the waiting period is 5 trading days in order to comply with Regulation M before ATM sales can resume. So now let's take a look at the row below for companies with a public float of 75 million or more, but less than 150 million. In the second column from the left, you will see that the securities of those companies still don't qualify as actively traded for purposes of Reg M, and so a Reg M restricted period also applies to those companies. In the next column to the right, you'll see that for these companies, however, they do qualify for the use of Rule 139 under the Securities Act. So unlike companies with public floats of less than 75 million, publication or dissemination of research report under Rule 139 will be an accepted activity under Reg M, which again technically enables the sales agent to issue research reports during a Reg M restricted period. That's why in the fourth column from the left, you'll see that there's no need to formally suspend sales in writing under the ATM program, and there's no need for the sales agent to file a restricted period termination notice with FINRA. That said, if you look at the fifth row, the fifth column from the left, there's still a minimum waiting period of 3 full calendar days before the research report can be issued as mandated by FINRA rules in the case of non-emerging growth companies. So sales under the ATM program should still be stopped for 3 calendar days, at least. As in the case of companies with floats below 75 million, there's another 3 calendar day or 5 trading day waiting period following the issue of research that must expire before ATM sales can begin again, as you see in the last column to the right. Now let's look at the next 2 rows below, the last 2. Companies with public floats equal to or greater than 150 million and average daily trading volume of in excess of 1 million, whose securities do qualify as actively traded under Reg M, and emerging growth companies as they're defined under the Jobs Act. For companies with actively traded securities, no Reg M restricted period applies. In the next column to the right, these companies also qualify for use of Rule 139 of the Securities Act. So for companies with both actively traded securities under Reg M and Rule 139 qualification, there's no requirement to formally suspend sales under the ATM and also no waiting period requirement under FINRA rules prior to issuing research or following the issuance of research. Now, having said that, some banks may, just as a matter of internal risk management policy, they may impose a waiting period, for 10b5 issues and things like that. But that varies among different banks. Likewise, for emerging growth companies, which are basically defined as companies that had less than $1 billion in gross revenue in its most recently completed fiscal year and have not sold common equity securities under an effective registration statement on or before December 8th, 2011, while they may also not qualify as actively traded, as long as they do qualify for Rule 139, there's no requirement to formally suspend sales under an ATM, and also no waiting period requirement under FINRA rules prior to issuing research or following issuance of research. So, next slide. So we've already discussed most of what's contained on this slide, but what I do want to highlight here is that while Rule 139 allows broker-dealers to continue to publish research for companies during an ATM program, the Jobs Act allows a broker-dealer to both initiate and continue to publish research coverage for an emerging growth company during an ATM program. So what that means is basically under Rule 139, the broker-dealer cannot initiate research once the ATM is used, because Rule 139 requires that at least one research report be published before Rule 139 can be relied upon. This means that there must have been at least one previously published research report within the past 12 months before the ATM program is in use, although it doesn't have to be a report about the same security of the issuer being sold through the ATM. Notwithstanding the broad scope of Rule 139 and the Jobs Act, broker-dealers typically review all research reports issued during an ATM program to protect against possible violations of Rule 10b-5 and other anti-fraud rules. Even research that's published outside of any applicable quiet periods and restricted periods, but in relatively close proximity to ATM sales, the agent must ensure that the report does not contain information that could be construed as conditioning the market to support ATM sales, as opposed to providing impartial analysis. Next slide. So let's talk a little bit about Reg M. Reg M prohibits an ATM sales agent in the company from bidding for, purchasing, or attempting to induce any person to bid for or purchase the same security being sold under the ATM program during the applicable restricted period outside of the ATM program. So the applicable Reg M restricted period in an ATM program begins either one full trading day prior to the date of pricing of each ATM sale, and that's for securities with average daily trading volume of $100,000 or more, and an issuer with a public float of 25 million or more, or for all other companies, 5 full trading days prior to the date of pricing of each ATM sale. In all cases, the restricted period continues until the sales agent's, quote, participation in the distribution has ended, which doesn't necessarily end when sales made under a particular placement notice are completed. Depending on the timing and the frequency of ATM usage, the Reg M restricted period may be extended and continuous between multiple placement notices, even when a placement notice is not in effect. Even if there is not one long continuous restricted period, multiple restricted periods may occur frequently throughout the ATM program. So as we discussed when we talked about research report, an extended restricted period and or multiple restricted periods during the term of the ATM program may affect whether the sales agent can issue research reports and whether the company has a stock buyback program, if it does, that are not conducted through an agent independent of the issuer need to be suspended. Next slide. So let's talk a little bit about principal purchases by the agent in privately negotiated transactions. So many ATM sales agreements specifically provide for direct sales to the sales agents as acting as principals in one-off trades akin to bought deals. So in that type of a situation, it might not be considered to be a true at-the-market offering, depending on the terms of that principal purchase. If so, that might require the filing of an additional prospectus supplement or Form 8K, since the original ATM prospectus likely only includes pricing and other terms relating to true at-the-market offerings under Rule 415. So a new prospectus supplement or Form 8K, if necessary, would need to include all of the pricing terms, including any discounts, commissions, fees, warrants, or other compensation items of value that were not set forth in the original ATM prospectus because such terms were not known at the time the original ATM prospectus was prepared. So basically, you need to assess whether a transaction such as a privately negotiated purchase by the agent as principal or other privately negotiated transaction could potentially implicate the 20% rule under the applicable securities exchange. You have to assess whether the dollar amount of shares that have been and will be purchased in principal transactions or other privately negotiated transactions that do not constitute at-the-market offerings under Rule 415 compared to the total size of the ATM program that has been and is intended to be sold through agented transactions that do constitute at-the-market offerings under Rule 415, and whether the amount referred to previously as compared to the entire amount of the ATM program would implicate the applicable stock exchange 20% rule, given the certifications that the company has to make at the outset of the program. Next slide. So let's talk a little bit about block trades and bought deals. As I mentioned with agent principal purchases, many ATM sales agreements also specifically provide for block trades and bought deals, in addition to principal purchases by the sales agent in privately negotiated transactions. So reasons why a company might prefer to conduct a block trade or a bought deal with an existing ATM program? Several. Preempting potential negative market reaction that sometimes accompanies a standalone trade. Fast and cost-efficient execution, since the sales agents are likely current on diligence and legal deliverables. Number of factors that the company might want to consider before and after effecting a block trade or bought deal within an ATM program include, does the ATM sales agreement provide the ability to do this? If the block trade or bought deal is big enough, it might warrant additional disclosure via brief, prospectus supplement, or 8K. Is it structured as an at-the-market trade, or is it a privately negotiated transaction? It's privately negotiated. Some same considerations regarding filing additional prospectus supplement or Form 8K to include specific pricing terms for that particular transaction. Now, the New York Stock Exchange has concerns that using an ATM this way could potentially sidestep shareholder approval requirements, and that's basically why it requires the company to certify at the outset of the program that sales under the ATM that are not true at-the-market sales through an agent are subject to applicable stockholder approval rules, or maybe. Under NASDAQ rules, basically the same thing. If the bulk of the ATM sales made other than through a sales agent on an agented basis in an at-the-market offering, that might trip the certification that the company made at the outset of the program and could implicate the 20% rule. So next slide. Briefly, preferred stock ATM programs. So a growing number of public REITs, particularly mortgage REITs, have expanded their use of ATM programs to include opportunistic selling of preferred equity securities, either in conjunction with a common stock ATM program or independently. Things to consider in connection with the preferred stock ATM program. Is it a listed series of preferred? Company must have previously made an offering of the same series of preferred stock and registered the outstanding shares and listed the shares on a national securities exchange. What are the rate and terms of the preferred? Preferred stock is less straightforward than common, obviously. It might be very complicated. The rate and terms of the listed preferreds are fixed for the duration of the program. Selling at a premium or a discount. So as long as the current market price is within a reasonable range of the stated liquidation preference, there should not be a problem with selling any new shares of an existing class of preferred stock into the market through an ATM program. So I think we're right at 4 o'clock, right about now. That concludes our program for today. Thank you everyone for joining us. Glenn, again, please return your completed attendance forms to attendance@dorsey.com. CLE certificates will be sent to those who return the completed form. If you have any questions, you're welcome to follow up directly with either Nicole or myself, or you can call your trusted Dorsey contact. Thank you, everyone, and enjoy the rest of your afternoon.